Hello investors and financial enthusiasts. Welcome back to our channel. Today we have a crucial topic to discuss that could significantly impact your financial future. We're going to talk about the impending economic crash and why diversifying your portfolio with a particular focus on commodities is more important than ever. Section 1, the impending economic crash. Let's dive right into the heart of the matter. Many economists and financial experts are sounding the alarm about an intense economic crash on the horizon. Several indicators suggest that the global economy is teetering on the brink of a severe downturn. First, let's talk about national debt. Across many major economies, national debt has reached unprecedented levels. For example, the United States national debt now exceeds $30 trillion. Such high levels of debt are unsustainable and can lead to severe economic consequences. High debt levels mean more of the government budget goes towards interest payments, leaving less room for essential services and economic investment. Next, we see slowing GDP growth. Major economies are experiencing sluggish growth rates, which indicates that economic activity is not expanding at a healthy pace. When GDP growth slows, it means businesses are investing less, consumers are spending less, and overall economic activity is stalling. But that's not all. We also have rising inflation to contend with. Inflation erodes the purchasing power of money, making goods and services more expensive. Recently, we've seen inflation rates climbing to levels not witnessed in decades. High inflation can lead to reduced consumer spending, as people can't afford to buy as much. And it also increases costs for businesses, squeezing their profit margins. These economic indicators are not isolated. They are interconnected and amplifying each other. High debt levels, slowing GDP growth, and rising inflation create a vicious cycle that can lead to a significant economic downturn. When these factors converge, the risk of a severe economic crash becomes very real. Section 2. The plight of small businesses. One of the most concerning aspects of this impending crash is the plight of small businesses. Small businesses are the backbone of the global economy, employing a significant portion of the workforce and driving innovation. However, these small enterprises are suffering under the weight of over-regulation. Let's break this down. Over-regulation refers to excessive government rules and regulations that businesses must comply with. While regulations are essential for ensuring safety and fairness, too much regulation can stifle business operations and growth. For example, complex tax codes, labor laws, environmental regulations, and health and safety requirements can all add layers of cost and complexity to running a small business. Small businesses often lack the resources to navigate these regulations efficiently, unlike large corporations that can afford legal and compliance teams. Moreover, the COVID-19 pandemic has exacerbated these challenges. Many small businesses were already struggling with tight margins and limited cash flow. The pandemic brought additional regulations, such as social distancing measures, capacity limits, and health protocols, further straining their operations. Without the support of small businesses, the economy loses a critical engine of growth and job creation. Small businesses contribute to local economies by creating jobs, fostering community development, and driving innovation. As more of these businesses close their doors, the ripple effects will be felt throughout the entire economic system, exacerbating the downturn. The loss of small businesses means fewer job opportunities, reduced consumer spending, and diminished community services. This creates a negative feedback loop that further weakens the economy. It's a serious issue that cannot be overlooked. Section 3. The importance of diversification. In light of these challenges, it's more important than ever to diversify your investment portfolio. Diversification helps spread risk and can protect your investments from the full impact of an economic crash. Let's take a closer look at what diversification means. Diversification involves spreading your investments across various asset classes, such as stocks, bonds, real estate, and commodities. The idea is that when one asset class underperforms, others may perform better, balancing out your overall returns. One key area to consider is commodities. Commodities like gold, silver, oil, and agricultural products tend to perform well during economic downturns. They are tangible assets with intrinsic value, providing a hedge against inflation and economic instability. Gold and silver, for example, have been considered safe haven assets for centuries. During times of crisis, investors flock to precious metals to preserve their wealth. Gold in particular tends to increase in value when confidence in paper currencies and other financial assets declines. Oil and other energy commodities are also essential components of a diversified portfolio. While oil prices can be volatile, energy is a fundamental part of the global economy. As long as there is demand for energy, investing in oil and other energy commodities can provide a buffer against economic instability. Agricultural commodities, such as wheat, corn, and soybeans, are another vital area. These commodities are essential for food production, and their demand remains relatively stable even during economic downturns. Investing in agricultural commodities can provide stability and security for your portfolio. During times of crisis, commodities can offer stability when other investments falter. By allocating a portion of your portfolio to commodities, you can help safeguard your wealth against market volatility. Section 4. Global conflict and economic stability. Another critical factor to consider is the increasing geopolitical tensions worldwide. Global conflicts have the potential to trigger a global depression, exacerbating the economic challenges we already face. Conflicts disrupt trade, increase uncertainty, and can lead to widespread economic instability. For instance, tensions in major shipping routes or key resource areas can lead to supply chain disruptions, driving up costs and reducing economic output. Let's consider the current geopolitical landscape. Tensions between major powers, such as the United States, China, and Russia, have been escalating. Trade wars, military conflicts, and political instability in key regions can have far-reaching economic consequences. When major economies engage in conflict, the effects are felt globally. One of the most significant risks is the disruption of global supply chains. Modern economies are highly interconnected, relying on complex supply chains that span multiple countries. A conflict in one region can cause delays, shortages, and increased costs worldwide. For example, a disruption in the supply of rare earth metals from China could impact the production of electronics and renewable energy technologies globally. Furthermore, conflicts can lead to increased volatility in financial markets. Investors tend to react negatively to uncertainty, causing stock prices to drop and market volatility to rise. This can result in significant losses for unprepared investors. As investors, it's crucial to stay informed about these global developments and understand their potential impact on the economy. By doing so, you can make more informed decisions about how to protect and grow your investments. Section 5. Final thoughts and recommendations. In summary, the signs of an impending economic crash are becoming increasingly apparent. High national debt, slowing GDP growth, rising inflation, and the struggles of small businesses all point towards a severe downturn. Additionally, global conflicts add another layer of risk, potentially triggering a global depression. To protect your financial future, diversify your portfolio with a focus on commodities. Commodities like gold, silver, oil, and agricultural products offer stability and security during times of economic uncertainty. Stay informed about economic and geopolitical developments and be prepared to adjust your investment strategy as needed. Thank you for watching. If you found this information valuable, please like and subscribe to our channel. Stay tuned for more insights and tips on navigating these challenging economic times. Until next time, stay informed and stay prepared. Remember, the key to navigating economic uncertainty is preparation and diversification. Stay vigilant and you'll be better equipped to weather the storm. Take care, everyone.